Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We like to talk to investors with a proven track record of good decisions to find out how they make the right calls at the right time. One of the sharpest investors in Australia is Geoff Wilson AO, the Chairman and Chief Investment Officer of Wilson Asset Management. Since 1997, Wilson Asset Management has grown to manage 8 listed investment companies with more than $5 billion in shareholder capital on behalf of around 110,000 retail investors. I wanted to speak to Geoff about how he sees the coming months for investors and what retail investors should be doing to position themselves for opportunities. Geoff Wilson, welcome to Fear and Greed.
Sean, thank you very much to be on. And I think with your introduction, you might have exaggerated.
Oh, we're expecting a lot, Geoff.
I know we've known each other for a long time, but that's right. It's all about sort of under-promising and over-delivering. So I prefer to focus on that.
I'm confident. Tell me, Geoff, how would you sum up the last 18 months in equities?
It has been an incredible period in the equity market. And whether it's the last 12 months, the last 18 months, with what the equity market has absorbed in terms of the sort of nearly total stopping of supply as a result of the pandemic. And even before that, the market had a phenomenal run, and that was all driven by record low interest rates and significant amounts of liquidity being pumped into the system. But sort of after the COVID breakout or adjustment to the market, there's just been an unprecedented amount of liquidity that central banks working pretty much, I'd say, together, and monetary authorities, again, with all those countries, really working together to stimulate the economies that could have, without that, been in very bad ways. So it really has been an unprecedented period of significant stimulus in terms of low interest rates or close to zero interest rates. And money being pumped into the system.
So the question is, what about the next 18 months?
That's right. Yeah, that's always the million-dollar question. As I've been around the market for a long time, I suppose I am nervous. And I'm nervous because of the excesses I'm seeing. I mean, if we'd done this interview a year ago, I probably would have been equally as nervous, and seeing some of the excesses that have crept into the market. We do know that one thing is bull markets, which we're in at the moment, they do climb a wall of worry. So I suppose that the hesitancy is good for the market to keep going higher. I mean, one thing we do know, I started in the market in the early 80s. That's 1980s. And one thing we do know is the market does perform over time. So there'll be periods where the market is overbought, expensive, and there'll be periods when the market's cheap. But as an investor, you need to stay in that market. I remember back in 1987, at the start of 87, everyone knew the market was expensive, and there were a lot of signs of excess in the market. In the Australian market, from the start of 87 till October, before we had, those have been around long enough, the stock market crash, the market went up 50% from the start of the year till before the crash, and it fell 60%. So in Australia, over the year, you lost 10%. But in the US, the market fell significantly there, not as far as Australia did. And 2 years later, it was at a new high. So the market does go up over time. And when there are periods of excess, the market can keep going up for a period of time. And so my sort of advice, even though I can only give general advice, don't overextend yourself, because the market has performed exceptionally well. And we've had bull markets in property, we've had bull markets in real assets, we've had bull markets in equities. We're in one of those periods. I would just make sure you don't overextend yourself. You've got enough money in terms of if the market does fall 20 or 30%, because it has had a big run. It was the best year last year for 30 plus years. So we're getting closer to a year that there's going to be a bad year. So just keep playing the market. Don't overextend yourself. Have a little bit of cash. Make sure you can go to bed at night. And if you woke up the next morning and the market was down 20 or 30%, you wouldn't worry.
I just want to talk a little bit about listed investment companies, because that's the LIC structure. It's something that you've followed. You've got 8 listed investment companies as well as 2 future generation companies. What is it about the LIC structure? I don't really understand it enough. What's the advantages of a LIC?
What I love about the structure is you can get exposure to, say, some of the best fund managers in Australia, or if not the world. And instead of paying what they're worth, you can get that exposure for a 10% discount or a 20% discount. And as an investor, I'm always a value investor. I love buying a dollar for 80 cents. I'd like to buy a dollar of assets for 50 cents if I could. And that's what you can find at various points in time with listed investment companies. First of all, what it is, it's a portfolio of shares, say 60 to 100 shares. The portfolio manager manages on behalf of the shareholders. It trades on the stock market. So you've got a board of directors that is accountable, and you've got a manager. So you as a shareholder, you can put pressure on those boards, and they're very, they have to comply with the various regulations. So you get exposure to that fund manager, assuming he's a good fund manager.
Yeah.
Then you get exposure to his ability to pick good stocks. It is a diversified portfolio. It's not like, say, buying a share in Afterpay. If you put all your money into one company, then obviously you're taking a lot more high risk, but then you get higher reward. If you want a more diversified portfolio and have someone managing it on your behalf, that is the listed investment company, like a managed fund, but at various points in time, their dollar of assets may be trading at 80 cents. So do your homework, try to find the good managers and try to buy them cheaply, when that dollar of assets is trading at 80 cents. And it does do that. And sometimes, like, we've got some listed investment companies, one of them, WAM Research, which has been going for a number of years, since 2003-4, it's a dollar of assets, but it's trading for $1.35. So it's as crazy that people are paying above what the assets are worth, as a lot of listed investment companies are trading below what the assets are worth.
So if I'm buying into WAM Research, presumably I'm backing the view that the fund managers actually can create value down the track.
That is, but that's a big ask.
Right.
In terms of, for anyone. So that's effectively what the market is assuming, that we can continue to perform. Say if you're taking a 10-year view, then we'd have to perform by at least 3.5% better than the market a year for 10 years consistently to make it a logical investment.
Yeah.
So that is a big ask. And what I like doing is buying a dollar of assets, and if they're trading at 80 cents, it's fantastic. 90 cents. But if you're paying less than what those assets are worth, because you've got to remember, those companies you've invested in, so you get the full benefit of those in terms of you get a dollar's worth of benefit. And in terms of if they're yielding, say, a 3% or 4% yield at a dollar, and if you can buy them at 80 cents, then you're getting that 4% on a dollar, but you're only paying 80 cents for it. So your yield is actually going to be 20% higher. It's going to be 4.8% rather than the 4%. So to me, they're not for everyone. The good thing is, what they also do is, listed investment companies, rather than all the profit they make each year, instead of just paying that out, they can pay it out over time. So what we find is self-managed super funds have been big buyers of listed investment companies. About 65% of our shareholders are self-managed super funds. And I think at the moment, over the last 12 months, we've had a lot of retail investors enter the market maybe for the first time, and they all like the idea of buying a company, and if it goes up 50%, they make 50% on their money. What they haven't seen yet is the other side, is at various points in time, those companies they buy, if the stock market does fall for some reason, then they can lose that money as quickly as they make it.
Yeah.
And then you tend to find then people will say, well, actually, I like the market. I know it can make money over time, but can I get exposure to, rather than taking the direct exposure to one company, maybe I'll have buy a listed investment company. If I can buy it cheaply, then I can get a cheap exposure to, say, 60 or 100 companies and hope that manager can create value.
Okay, stay with me, Geoff. We'll be back in a minute. My guest this morning is Geoff Wilson, Chairman and Chief Investment Officer of Wilson Asset Management. The other thing I want to talk to you about is active investing. Now, I remember the first fund manager I ever quoted, or market analyst, was you, believe it or not. And this must have been in the early 90s, and I worked at the Sydney Morning Herald. And Matthew Kidman, who comes on the show, it was a journalist at the time, and he said, give Geoff a ring, he'll actually talk to you. And what I remember from it, I mean, I can't quite remember what your quote was, but I had tried 3 or 4 people, And they didn't want to talk about stocks, which always sort of surprised me. From that moment, though, you've always believed that it was important that you had a voice, as a shareholder particularly, that you do have a voice. Now, that doesn't mean you always are public about it, but sometimes you are public about it. How important is it for shareholders to be, when I say activist, I don't actually want a value judgment on that. I just, actually have their say within a company?
Yeah, I think you're 100% correct. And I don't think you really need to be an activist. I think you need to be active. And the thing that shareholders probably underestimate is the power they have. Because you've got a board of directors that are sitting there, they're having their board meetings, once a month or once every couple of months, and they've been given information from the management. Very rarely does the board get sent letters, the chairman and the board, about concerns that shareholders have. And to me, you would be surprised writing a letter to the chairman of the company, if you're disappointed about something, conversely, if you're happy about something. To me, it's very good to do the both side, the pluses and the minuses. But if you are disappointed about something, then make sure you write to the chairman of the company and write to the board and ask for it to be tabled at a board meeting. Then all of a sudden, you may be the only letter. So you've got 100% of the people that are responsible for looking after the company focusing on what you're saying. So people do underestimate the power of a letter to chairmans and boards. And to me, one of the good things is, in the early days, there was a lot of talk about having to vote on the remuneration report. I was actually against it because my view was, it was just a waste of time. Within probably the first year, I realised it actually wasn't at all. It was an ability to engage shareholders again, which to me is incredibly positive. It gives them a voice. Now, the number of people attending AGMs had dropped off significantly over the last 3 or 4 decades. And this all of a sudden sort of has reinvigorated shareholders, given them a voice, and really made management accountable to a significant degree. Where, go back, say 10 years ago, we, as professional investors, institutional investors, we were only dealing with the managing director of the company. Now we get to see not only the managing director of the company, we see the chairman, who 20 or 30 years ago we would have never met, and even some of the board. So to me, it really has engaged the rest of the board. And to me, anything that engages the board, who are only there, they're there to service shareholders. Unfortunately, some of the boards think they're there to service themselves in terms of get paid and do what they think is wise. But effectively, shareholders can vote them out, and that they have to understand they are accountable to shareholders. So to me, that's having shareholders having their voice is very important.
Now, I can't let you go without just asking you about Myer. You're the second largest shareholder in the department store. What are your thoughts on the company? Obviously, the largest shareholder is an active investor in that company and pushing for board renewal. What's your take?
The good thing is, Sean, whether you've got 20 or 30 years of experience, to me, that's always one of the good signs of an interviewer. There's no beating around the bush, just straight to the question. Now, in our portfolio, we get a lot of write-ups in the papers about our being a shareholder in Myer. It's a fraction of a percent in our portfolio. So it's a very small exposure for us, but gets enormous amount of free publicity on it. We bought it to back the management team. That's John King and his management team. And we started buying, I think it was nearly 3 odd years ago, and we started buying at 40 cents. And this was before, obviously, COVID, which obviously we didn't expect and had a significantly negative impact on the company. The good thing is we're actually now making money. We're a believer in backing management teams. We believe the management team's done a good job. You see the share price is reflecting that. With Solly there as a major shareholder. Again, we all know Solly is a fantastic retailer, has great experience. To me, you'd like to harness all the positives from Solly with John King and really get Myer motoring along and performing well. That would be my dream. Whether we get there, who knows? We are still, as you said, the second largest shareholder. When we come out of lockdown in Sydney and in Melbourne, which eventually we will, we think John King and his team have done a good job reducing costs, moving more to online, and if we can enhance Myer with the Solly's experience, I think you've got a very exciting company again.
Geoff, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Geoff Wilson, Chairman and Chief Investment Officer of Wilson Asset Management. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.